Clive McDonald, Head Equity Strategy at StanChart, joins us now from Singapore. Clive, hi, morning. What is your stand on Asian equity? So far in 2013, it has not been, great for them. Do you expect them to do better in the next 9 months?
Yeah, I think Asian equities, really post the Obama inauguration or re-election win back in November, have done actually quite well through to the beginning of February. But since February, Asian equities, as you point out, have stalled. And that contrasts with the performance of the more developed world, which has continued to head higher. I think part of the reason for the stalling in Asian equity performance, two factors. One is the yen, and second has been uncertainty with regard to the outlook for the Chinese economy yet again. Looking into the remainder of the year, while the yen will definitely continue to buffet the Korean equity market, we believe that the outlook for China is actually getting incrementally better, and that as equity market confidence returns, we should see the China market head higher, and that helping overall sentiment towards emerging Asia.
Clive, good morning. In your last report, you were overweight on India. Do you still find India attractive? Because I see that, I'm asking you whether you still have a target of 22,000 on the Sensex.
Yes, we are constructive towards the Indian equity market. 22,000 remains our Sensex target, about 16% upside from here. A couple of factors drive our optimism there. I think that first of all is the fact that earnings revisions have been quite positive in India. We're looking at about 15% EPS growth for FY14. And also if we look at the reporting season, taking away the outliers, the hit-miss ratio in India has been about 1.5 to 1. So specifically 1.5 companies have beat consensus expectations on earnings relative to each one that has missed.
So what can take the Indian markets higher from here, Clive? Will it be better earnings or continued strong fund flows?
I wouldn't expect portfolio flows to return to quite as strong as what we saw in December and January. And that implies to move higher from here, we need to see corporate earnings expand in line with expectations, we would say. We're looking for 15% EPS growth, as I say, for FY14. We're looking for the equity market to rise about 16%. So not looking for a lot of multiple expansion, keeping in mind that we have had considerable multiple expansion over the past 6 months, but really it's about the earnings follow through, which can carry the market towards our 22,000 target.
What about risks? Politics, inflation, slowdown in growth, do they worry you?
Well, the inflation picture is improving. We've seen the RBI cut rates twice now over the past number of months. Inflation coming in about 6.8%, certainly higher than what economists would like, but it has come down significantly from where we were at the high point late last year, or mid last year, in terms of double-digit inflation. And we think it will continue to edge lower. In terms of growth is already slowing, but we would argue that the market is aware of that. And looking ahead into FY14, if we get that pickup in investment, which the government continually talks about, and some corporates are making positive sounds about, we think actually the growth profile is probably bottomed and can get incrementally better from here. Not dramatically, we would concede, but see a bit of an improvement in economic growth.
So what sectors do you like when it comes to India?
Within India, we have a more broad-based approach than we have elsewhere in other markets in the region. We favour some of the cyclical names in the capital goods or industrial space, as well as some of the information technology names in the software services, and selectively some of the pharmaceutical names as well.
Finally, what about global equities? Do you see any danger to the great rally or the rotation rally that we talk about? Any danger of investors moving back to US and Europe equities as opposed to emerging market equities?
Well, already we've seen the developed world equity market led by the US significantly outperform the emerging world year to date and since the Obama re-election back in November. With regard to the great rotation, we don't see it at the moment. We are continuing to see inflows towards bond funds in the developed world as well as equity funds. The real rotation that's taking place at the moment is away from ETFs towards actively managed funds.
Clive, good chatting with you. Appreciate you taking the time out and joining us on the show today.